Hi, I'm Saul Miller, the Portfolio Manager for the Nedgroup Investments Balanced Fund. Thanks for joining. This is the performance of the fund since inception. Last year was a bit of a tough year for us. The last 3 months have been a bit better. Here I just want to show you what contributed and what detracted over the last 12 months. So we had a hedge on the US market that obviously hurt us over most of last year. We have some exposure to commodities, which also detracted from performance over the last 12 months. And in terms of what contributed to the fund, it was our exposure to offshore equity, offshore debt, as well as SA bonds. With that, let me move on to our investment view and take on the world. So what you have here are the expected real returns for a number of key regions in the world. And in yellow, what you see are the relative valuations. So these are the PEs of the different regions or countries relative to their 10-year median. So if you look at the bottom, you'll see India has quite low expected returns. It's trading on a very high PE relative to history, and that's because it's one of the new growth engines of the world. So there's obviously been a lot of excitement around India, but valuations are fairly stretched at this stage. The US market, we think, is particularly expensive. It's on a 20 PE plus. You've got about an expected return or real return of about 3%. If you compare that to bonds, where you're getting about a real return of a little bit more than 2%, that's a fairly paltry equity risk premium. We would actually prefer to be in US debt or short duration credit rather than the US equity market. If we look at the rest of the world or other regions in the world, you'll see they actually look fairly reasonable, giving you a 4+ real return, valuations not too out of line with some history, and that's where we've chosen to take our offshore exposure. So in some of those regions like Asia ex-Japan and Europe, where we're seeing a reasonable amount of value, and we'll dig a little bit deeper into that in a second. If you look at Chinese market has underperformed quite dramatically over the last few years, so it's no surprise that their valuations are cheap. They have a high expected return, but there's also quite a lot of risk associated with investing in China at the moment, be that economic risk or geopolitical risk, and for that reason we still have quite a modest exposure to China despite the fairly compelling valuations. I just want to dig a little bit deeper into some of the markets. So we know that the US market's done very well on the back of this AI theme that has driven a lot of the very large cap growth shares in the States. Now, even if AI turns to be a fantastic opportunity for the economy and we get a lot of growth from shares related to that, what's interesting to see here is a lot of that is already priced into those shares. Here you can see long run earnings expectations from market participants, and you can see it's about as high as it was during the bubble of 2000. So very lofty expectations being priced in to those shares, and hence we are quite wary of them. If we look at the cheaper segments of two markets, of the US and Europe, and what I'm really talking about here are the value segments of those markets, and we're using the MSCI value indices for this. What you can see is even in the value segment in the US, valuations are quite stretched relative to history. They're over one standard deviation expensive. They're sitting between about 16 and 17. So there's not a lot of value in the US market, hence our significant underexposure to that market. Whereas if you look at Europe, you'll see that European value is actually trading at a discount to its history. And there are a lot of interesting segments in that market. You've got financials, you've got energy. Not only are they quite cheap, they're also engaged in a lot of share buybacks, which is also obviously enhancing shareholder return. With that, I'm going to move on to commodities. What I've done here is I've overlaid the manufacturing cycle with commodity prices, and what you can see is there's a reasonable positive relationship between the two. It's not surprising. As manufacturing picks up, you use more commodities in that process, and this is fairly widespread across many regions in the world where we're seeing a bottoming out of this process. So this bodes well for the demand of commodity prices. If we look at supply dynamics, they're also quite positive, and here what we're looking at is the supply of copper or expected production of copper over the next few years by various key copper miners. And what you'll see is there have just been downgrades, actually significant downgrades over the next few years. And that also bodes well for copper prices going forward. And that is positive for the likes of Anglo American and Glencore that have significant exposure of their profits coming from copper, and hence our exposure to those two miners. If you look here we have the expected demand growth and those revised supply numbers. And when you look at that, you can actually see the sizable deficits that are creeping up in red over the next few years. Finally, on the commodity side, I just want to touch on gold. As you all know, gold has done tremendously well over the last year. And really what we're looking at here is we're looking at gold relative to the real yields on US bonds. Now, just bear in mind that the index, or that the right-hand side is actually in reverse. And that refers to the US real yields. So you actually have a negative relationship between US real bond yields and gold. And really the story behind that is, as real yields on US bonds fall, they become less compelling and investors would rather buy gold. So that's sort of the rationale for that relationship. But what you can see here is it's actually broken down in the last 2 years. And we think that is really associated with geopolitical tensions. Specifically, if you would have seen what would have happened post the Ukraine war, there's obviously been a lot more concern around central banks having their dollar reserves being frozen. And as a result, they would rather go into an alternative asset. And obviously a global asset would be gold. And you can see those significant purchases across all central banks really spiking up aggressively in the last 2 years, and it's particularly high when you compare it to quite a substantially long time period. Now, we don't think the landscape for geopolitical risk is going to change much from here, and hence we think gold will probably remain elevated, and hence we maintain our position in gold. Finally, moving on to South Africa. As we know, valuations are cheap. They've gotten even cheaper in SA. We think that SA should benefit from an improvement in the commodity cycle. They should benefit as well from this manufacturing cycle driving up EM. But that benefit will probably be muted by the upcoming election, where there's quite a bit of uncertainty. We're going to need to get that out of the way before we see any kind of uptick in SA valuations. Nonetheless, even if you don't get a re-rating of valuations for many of these SA shares, they are giving us particularly generous dividend yields, and you can see the IRRs, which are really our expected returns over the next 2 years, assuming no re-rating. So you take an ABSA on about a PE of 6. Even if that PE doesn't increase, we still think you could get about a 22% return. So there is a lot of value here, which is why we still have a modest exposure to SA assets. So just to summarize the points that I've made, I mean, first of all, we think the US market is expensive, which is why we are not exposed to the US market. There is reasonable value in many other markets, and hence our exposure to many of those other markets. We think that returns from developed market debt like the US, particularly short-dated credit, is compelling, and certainly more compelling than US returns. We're constructive on commodities, given what we're seeing in terms of the manufacturing cycle. That's obviously also good for EM. It should be good for SA, but that benefit will probably be a bit delayed, given that we have to get elections out of the way. I just want to touch on the asset allocation and positioning of the fund. We currently have about 40% of the fund in direct offshore, and we have a little bit over 65% in equity. So first of all, on the resource side, as I said earlier, we think there will be copper deficits, which is particularly positive for copper prices. That is of benefit to the likes of Glencore and Anglo American that have substantial exposure to copper. We also have the fall in iron ore, which has finally taken place, so that should be less of a headwind for Anglo American that's also exposed to iron ore. In fact, we've actually seen iron ore prices ticking up, so that should hopefully help their profits going forward. If we look at offshore positioning, as I said, we think that foreign developed market debt is quite compelling. We're getting a yield of about 7% in hard currency at the moment from that. And then in terms of our equity exposure, we are underweight the US. We like Japan, where you're seeing some structural and cyclical changes. And we also like the European Union, where we're seeing a lot of very good value opportunities in that market. In terms of SA, domestic financials, as I showed earlier, you're getting fantastic dividend yields from a number of financials. If you take an Investec, half of that is actually exposed to the UK, so you're also getting a bit of a rand hedge as well. If we look at some of the offshore exposed companies that are listed in the JSE, we actually have fantastically high quality businesses there as well. The likes of Anheuser-Busch and the likes of Bidcorp. Bidcorp should deliver fantastic earnings growth going forward, not just through top line growth, but through better efficiencies in their business, which should mean further margin expansion. And then finally, if we look at some of the smaller industrials on the SA market, particularly the small mid caps, You're seeing a lot of shares trading on particularly low PEs of 5 to 6, so reasonable value in that segment as well. And then if we look at our bonds are giving pretty generous real yields. We have one of the highest real yields in the world, and hence we do have some exposure to SA bonds. The duration as a percentage of the whole fund is still quite low, given that we do have exposure to some short duration floating rate debt as well. Thank you very much.